Markets are whipsawing on just about every headline: tariffs, trade wars, and reshoring. But with stocks essentially flat and volatility mostly muted, have investors or markets become too complacent? Today, we're going to cut through the noise to ask, what is the market really telling us? Stay tuned for this episode of UBS Trending. Hello, everyone, and welcome to UBS Trending. I'm Anthony Pastore. Thanks so much for being with us today. I'm in the studio with two guests, Paul Shao from the Chief Investment Office, who's going to give some of the economic perspectives of the conversation. And back in the studio with us is Moritz Pott from Tema ETFs, and he's going to give his expert analysis talking about reshoring, what's going on in the equity markets, and more. So lots to get to today. Gentlemen, first of all, one of the things me and the team have been talking about a lot, and I know CIO's talking about this as well, is looking at the markets from January 1 to where we are today in early June. But really, when you look at, Liberation Day, when tariffs were first announced, with that significant market dip, when you look at just the equity markets, it's essentially round trip. The S&P is flat now for the year. What are your thoughts on what's happening right now?
There's a lot of noise in the market today. Investors are trying to find clarity amidst the noise. I think short-term, people are giving the economy the benefit of the doubt. I think inflation is yet to really creep up. You're yet to see a spike in unemployment. You're yet to see a material slowdown in the economy. There's some sectors where, frankly, growth is more or less encouraging. But frankly, the real focus is, how do we read into the situation? There's little precedent. This has all moved really fast. And at the same time, people were hoping for decisions. But it turns out decisions are taking longer than expected. If you just think about the trade deals, the US has announced one relatively modest trade deal with the UK. There'd be no other major trade deals announced. So I think the view is the economy is not in a bad shape, but investors are frankly on the fence, but for now they're giving the benefit of the doubt.
Yeah, but you're looking at the bond market now, and as I said, the long end of the yield curve, which is a normal yield curve, is showing indications that investors think that inflation could be an issue, but they're going to get rewarded if they go out 10, 30 years on that yield curve. So when you're looking at the bond market and, of course, all the economic data and Fed expectations, what are you seeing in there?
I think from the bond market, we see one of the larger constraints on the White House that they haven't had before. So in the beginning of the year, as we got into Trump's second term, there were a lot of unknowns, what he could possibly do with what's happened. And the tariffs that were announced Liberation Day, I think, took a lot of investors by surprise. But since then, more than almost 2 months out from that, we've seen a number of constraints on the White House, right? One is the bond market you were talking about how that these tariffs are not necessarily growth strengthening, especially in the short term. So that will exacerbate deficit, debt to GDP ratios. And that's a concern for bond markets right now. The second sort of constraint is the low approval ratings, not only from Democrats, but also from independents and presumably people of his constituents. And a reminder that tariffs last week, there was a court that ruled that the basis of IEEPA, the legal basis to implement tariffs, was ruled illegal. That wasn't brought upon by Democrats. That was brought upon by a federation of small businesses in the U.S. that presumably are part of his core constituency. And so ahead of 2026, that's another thing that the White House certainly is paying attention to. And then finally, we're, I think, 150 days in from Trump's second term. The legislative agenda is increasingly packed. There's a budget they need to pass. They've signaled that they want to prioritize the extension of the Tax Cuts and Jobs Act. So there's less room than the start of the year to have a lot of, let's say, uncertainty-provoking policies like tariffs that the White House can do as we go deeper into this administration.
Right. There is a lot of noise, and you bring up the policy agenda. There's so much on the docket, and they're trying to get this tax bill to be reconciled and go through the Senate. But there is just a lot of noise, and it feels like maybe it's not complacency, maybe it's just distraction, and I'm not even sure as an investor, what will I do here? And then dipping into the reshoring aspect, does all of the tariff news, does it make you think differently about what you thought about reshoring before Liberation Day?
Yeah, it's a very good question. So this year has seen a record number of reshoring announcements, and we've seen over $2 trillion from over 40 different companies spanning more and more industries. So we're starting to see reshoring in areas such as healthcare, which we didn't see before. I think the big question is the impetus on Made in America is not changing. I think what people have been surprised by is that companies that they thought would be very insulated in a pro-America or pro-Made in America environment, they've actually also sold off quite indiscriminately. So I think midterm, people understand the direction of travel. I think people are uncertain short term, if there's a recession or if there's potential slowdown, does that actually affect some of the companies that people expected would benefit from reshoring? So I think clearly the impetus for reshoring is there. What companies are also telling us and also mentioning publicly is this uncertainty for them is very unhelpful. So companies ultimately don't control the situation. The one thing they do control is where they invest their money. And I think companies are kind of jumping the gun and saying, listen, we don't know what's going to happen to taxes or to frankly, to tariffs. We're going to preemptively already start to reshore. And these are commitments that frankly are typical. We have not seen any reversal of. So these are big long-term commitments. So we think the trend will only continue. If anything, it will accelerate. And while the consumer may be more agile with uncertainty, the corporate, frankly, invests through periods of uncertainty and tries to think about what do they control, what do they not control, where they invest, where they produce is something that they increasingly want to focus on controlling.
Right. I just want to stay on that for 1 second with you, and please feel free to chime in. When you look at the reshoring opportunity, I think for investors and for Made in America, it seems really a smart move. But then you think about the average consumer, and obviously wages and labor in countries like Mexico and China and Vietnam, where a lot of our goods and electronic components are made, is something like 70 to 90% lower than a U.S. wage. So that means even if half of, and I looked at this from your U.S. Bureau of Labor Statistics and other data, if you even move half of the manufacturing onto American shores, it can increase costs for the average American consumer by 40%. Paul, what about you on the Made in America side when we talk about reshoring from the Chief Investment Office's perspective here at UBS? Talk about that viewpoint a little bit.
Sure. So back in 2023, we came out with a report titled Roaring 20s, like what are the things can go right this decade where we can grow above trend. And a couple of things that we highlighted where technology is a front, robotics, AI automation, but also immigration as a benefit to the US. And clearly those things I think will be largely affected by a Made in America scenario. I think a big question, especially for the Fed, is the impact on prices. So you have already how tariffs can make some goods more expensive. One benefit that the US has relative to other countries is that the US mostly is a services economy and consumers mostly spend most of their income on services. So there's some insulation on that front. But you already have the unemployment rate close to historical lows. Yes, it's backed up a bit from the lows we've seen, I think, in 2023, but it's still right around, I think, where the CBO would consider it to be NAIRU. But if you have more manufacturing jobs coming back and immigration stifled, I think you'll have a lot of companies will struggle to find the right workers in a very tight labor market environment that could push wages up higher, and that puts the Fed in a pickle because they do express a desire to cut rates to closer to neutral territory, but there are significant price pressures that would be coming, whether it's through tariffs or through a tight labor market.
Right. And we know that the Fed has a dual mandate of controlling inflation and also making sure that jobs and the economy are strong. And when we look at, we don't have the data yet as we're sitting here for the May jobs report, but the April jobs report looked pretty strong and robust considering, that the last 2 years, 3 years, we've seen an increasingly strong job market. So it doesn't look like there's any signs of an economic slowdown.
So you think about consumer vulnerability versus corporate stability. And I think clearly short-term, the consumer does feel more vulnerable than the corporate. If you look at the latest data in the ISM that published last week, actually that published very well at one of the highest levels in 12 months. But yet consumer indices have actually recently shown some weakness. So I think what you're starting to see is you're starting to see a potential bifurcation, also in alignment, but also in vulnerability between the consumer and between the corporate. Overall, though, I think we've seen a very strong jobs market, and we've seen employment levels that, frankly, would not suggest there's any immediate concern. These things can turn pretty fast.
Right.
And it seems like the market is basically giving the administration until the end of the summer to really come up with a number of, or more clarity around what's happening around trade. I think obviously people would have liked it to come earlier, but it's just taking more time. If there's no clarity by the end of the summer, I think we could have a pretty stormy September, October.
Right. I mean, let's be real. This is probably the biggest change in tariffs we've seen in 100 years.
Yeah.
And so there's a lot that not only does the administration have to work through, but we as consumers and investors and just American citizens have to think, well, how do we navigate all this through that noise?
And I think that's why they've been on hold for this year,
Right.
and they're not fully committal on rate cuts in September, for example. It's a sort of like wait and see mode, seeing more reactive, let's say, compared to what they have been in the last couple of years. I think if you look at U.S. data, exactly what Moritz said, the hard data has actually held up very well. It's in positive territory. But when we look at soft data, small business sentiment, consumer sentiment about their job stability, that's much lower than what you'd expect. It has picked up, consumer confidence has picked up a little bit, but it's really this uncertainty, this fear about price pressures, I think is limiting the consumer from spending more.
Yeah. I want to ask you both about, Moritz, I want to ask you first about supply chain issues, because we've obviously talked about that in our recent discussions when you were back here in March with us. And obviously this is a very big hypothetical, but you think about if we actually do implement these 145% or higher tariffs on China, are you concerned about potential supply chain issues in this environment?
Yeah, it's a good question. I think one lesson from the last few years is that corporates are increasingly focused on supply chain security, not just supply chain cost.
Right.
And one of the incentives behind globalization in the last 20 years was really optimizing for cost. But in a world where you're optimizing increasingly for security, you're prepared to actually sacrifice some margin in order to ensure that you can produce closer to your consumer, you can produce closer on time, and you can also produce with a relatively good outlook or forecast stability. So I think corporates have already been adapting their supply chains. I think the question is, if we end up with a 100% tariff, that's an earthquake in terms of the impact. I think no corporate could anticipate that.
Yeah.
So I think the focus on supply chains is definitely there. What I don't know is how severe the shock could be. And the shock may be severe enough that the supply chains haven't adapted enough.
Right. I was having a conversation with a friend over the weekend, and we were just literally talking about all of this stuff. And I was preparing for sitting down with the both of you today. And I said, I wonder if it's the case that, only 4 or 5 years ago now, we all suffered through the worst pandemic that the world had seen in a century. And we kind of got used to a lot of volatility, initial declines in markets, then initial spikes, and then people were getting into the markets and making money really well. They're working with their advisors. And I wonder if this just sort of feels like more of the same. It's really, the dust has barely settled on the pandemic for 5 years ago. And I wonder if that's part of the reason why investors out there are just thinking, well, I'm just going to have to ride this out like we did in 2020 and see how it goes. I just wonder how much of that is maybe playing into the way markets are trading today and how investors are reacting. Certainly,
and I think that's one of the reasons why in CIEO, one of our core messages is to take advantage of any sell-off opportunities, whether it's equities or in the dollar. While growth is expected to be more modest this year and the year after, I think the economy in the US is different than what we saw last cycle. Productivity is higher. There is more demand for jobs. Consumers have been spending, at least for the first 4 years coming into 2025. And even with tariff shocks, relatively high interest rates, odds of recession, at least for this year, have come down a lot. So there is, I think, a resilience to U.S. markets.
Moritz, just to give you the final word here, what are you talking about with investors and your clients?
So we try and avoid short-term noise, and we try and take a long-term perspective. And I think, we try and read between the short-term noise to understand, have the fundamentals or have the facts fundamentally changed? I think the reality that risk has gone up, fragility has gone up. Short-term, we're not seeing that in earnings yet. What we recommend is focusing on durability, on quality, and being more discerning. The market doesn't seem very discriminate today. I think investors have every reason to be more discriminate.
Thank you, Moritz. Yeah, very, very, very similar to our Chief Investment Office view here at UBS. Long-term investing, working with a financial advisor, obviously they are the people who can keep you on the right track, and they know exactly what you need in that portfolio to continue and maintain whatever it is, whether it's 30 years of investing or 5 or 10 or less. So thank you, gentlemen. Great to have you. Paul Schau, Moritz, thank you for coming back. Moritz Pott from Tema ETFs. Good to see you both.
Thank you for having us.
Great conversation. Thank you. And thank you all for joining us. Hopefully you took a lot of information away from this chat that I just had with Paul and Moritz. You can make sure to follow all of the content that we're creating here at the Chief Investment Office at UBS at our website, ubs.com. uk/views. Plus, you can follow UBS on social media. We're on LinkedIn, Facebook, and Instagram. Follow the studio specifically. We have our own Instagram channel at UBS Trending. Lots of content there for you. And as always, please, we recommend you continue this conversation with your UBS financial advisor. Till next time, I'm Anthony Pastore. We wish you a great rest of your day, and remember to keep your eyes on what's trending. We'll see you soon, everybody.